Good afternoon or good morning, depending on your time zone. My name is Tom Franz. I'm the Director of Client Services here at Integrity Data. We do recognize your time is valuable and we thank you for joining us today. Please note that we will be answering questions at the end of this webinar, so please feel free to submit your questions at any time throughout the session. You can generally do this in the GoToWebinar control panel, typically to the right of your screen. We do have everyone on mute. We do have a large audience today, but those questions can be put in at any point. Quick look at our agenda. We'll do a quick introduction. We'll talk about the current state of affairs with the ACA, and then we'll get into our refreshers, the main meat of our presentation for today, and talk about recap the employer mandate, how to do an ALE determination, what a qualified plan is. We'll talk about tracking employee eligibility and the required record keeping for IRS reporting, and then talk specifically about what we have to do in 2019, how Integrity Data may be able to help you with that, and again, that time for Q&A at the end. Our legal disclaimer, this is not legal advice. So Integrity Data has been in business for over 20 years, and the Affordable Care Act has proven to be confusing, especially for employers because of the employer responsibilities under the ACA and the fact that they're not always clear. Today's webinar aims to help employers understand the employer mandate and be clear on what it means for you. So our goal is to give you an overview of the employer mandate and the record keeping that's needed for required IRS reporting around the ACA. So I'm sure some of you may be wondering what is the current status. There was quite a bit of movement over the last 2 years in relation to the ACA. We had executive orders, some congressional activity, a tax reform bill, some continuing resolutions. In 2018, we did have a Texas ruling. However, none of this had any impact on employer compliance. So even the individual mandate change going to zero still has not yet affected employer compliance, including the reporting requirements around the individual mandate. We may still see something along those lines for next year's reporting, meaning tax year 2020 reporting, which will be done in 2021, but time will tell on that. Again, no impact on employer compliance. So in 2019, we have had some activity. Texas court, federal court in Texas ruled that the ACA was invalid, or we'll talk about that more here in just a moment. The California legislature passed some state-specific healthcare requirements. Forgive me, my notes aren't coming up on the slide here, so I'm having to kind of click back and forth. So in Texas versus United States argued that the Affordable Care Act individual mandate was invalid without a tax or penalty amount. But pending the appeal process, the ACA remains in place. So there's no confusion there. There's still required reporting. An additional argument related to inseverability attempted to invalidate the entire ACA law as part of that ruling. So in a previous Supreme Court case, it was argued that you cannot separate any part of the law. It's an all or nothing type of thing. The current argument is that if the individual mandate is unconstitutional and you can invalidate only you cannot invalidate only an aspect of that law, the entire ACA is unconstitutional. So should this ruling and its subsequent arguments find find a home in the Supreme Court, we could see a reversal, but the consensus is that won't happen until well after the next presidential election. So really makes sense to continue with your compliance activities. California is the most recent state to pass legislation that will impose a state individual mandate requiring all of its residents, including spouses and dependents, to obtain qualified health coverage or face a penalty. This mandate goes into effect on January 1st of 2020 and will impose a penalty on state residents who fail to maintain minimum essential coverage for every month of the year. The state mandate is expected to affect the reporting for California employers, but details have not yet been specified. Other states that have already passed their own statewide individual mandate include New Jersey, Massachusetts, Vermont, and the District of Columbia. Maryland is the next state that's seriously considering a statewide individual mandate. So remain informed and try not to worry yourself with what ifs. Research indicates ACA penalties are going to hurt based on our experience from prior tax reporting periods. Accenture researchers revealed an additional group whose penalties could be attributed to employers that are unintentionally non-compliant, meaning they offer health coverage but fail to meet the IRS reporting requirements at the end of the year. Adding salt to the wound, penalties could be piling up for employers that are completely unaware they incurred penalties in the previous year. While employers might hope for changes from President Trump to eliminate some ACA obligations, the reality is these changes are not going to take place quickly. It's also likely some level of employer reporting will continue with any type of replacement law, which could still include some kind of advanceable refundable tax credit that's going to keep that employer reporting relevant. So with the reporting deadlines right around the corner for 2019, the IRS is likely expecting employers to file in accordance with the ACA legislation in place at this moment. All right, so as part one of our refreshers here, we're going to do a quick recap of the employer mandate. This law does not apply to you if you have less than 50 employees. That's pretty clear. But every U.S. employer with at least 50 or more full-time employees, including equivalents, we'll talk about that more here in a bit, do need to be compliant, and you need to consider commonly controlled and affiliated companies when determining your ALE status, meaning you have to combine your head counts amongst those organizations. So employers' responsibility under the Affordable Care Act go beyond finding a suitable group health plan. There are in fact two levels of ACA compliance for employers. One, you have to offer the right coverage to the right employees at the right time. And two, you have to document for those employees and the IRS that you did offer what you were supposed to offer and that you did so when you were supposed to do so. The first level is called the coverage mandate. You may hear this mandate referred to as pay or play rules, which say that you risk a penalty if you offer no coverage when you're supposed to, and another penalty if you offer non-compliant coverage. Second level of ACA compliance is for employers is the related reporting obligations for what coverage was or was not offered. You may hear this requirement referred to in terms of the IRS form that the ACA created, the dreaded 1095-C. To comply at both these levels, you need to find ways of getting your data monthly in order to know who you should make an offer to, when you should make that offer, and whether the cost of that offer fits within the affordability guidelines for each of your eligible employees. You will face serious financial consequences if you do not comply with both the coverage mandate and the related reporting requirements. So let's talk a little, I mentioned the ALE determination. Let's look into that a little further. First, the ACA employer mandate only applies to U.S. organizations that are an applicable large employer, or ALE for short. These are U.S. employers with 50 or more full-time employees and equivalents in the previous tax year. So when you're determining whether you're an ALE for 2019, you have to go back and look at your employee base in 2018. It's likely that you already know that you're an ALE and the mandate applies to you. But if you aren't certain, be sure to watch our 101 educational videos, linked to the slide deck, which you will receive after the webinar from Lindy, for more information on that. You will need to be aware of these details when determining classification. Your ALE status is not a once and done determination. It's calculated annually as part of your report to the IRS so that they know each year which employers they can expect submissions from in the following year. So Form 1094C has that necessary information for your ALE status. If your company was not in existence for all of the previous year, you're still required to comply if your average headcount of the months for which you were in business was 50 or more full-time employees and equivalents. And the law was written to deter employers from splitting a company into separate entities in order to avoid offering health insurance. Therefore, you will have to look at IRS rules for controlled and affiliated groups when determining your ALE status. These rules are complex, and confusion stems from the fact that if you fall into this group, your corporate tax returns may be filed individually. If you have any doubts, we recommend seeking legal advice from an accountant or ERISA attorney. An employee is eligible for insurance when they are a full-time employee as defined by the ACA. The ACA has redefined full-time employee by abandoning the concept of a 40-hour work week to be classified as a full-time employee and reducing that threshold to 30 hours per week. By increasing the hours that need to be tracked when crediting employees with hours of service, this also has the effect of increasing the number of employees that may be eligible for health insurance. So learn more about hours of service, review our 201 webinar around guidelines for classifying an employee as full-time. Note that this 30-hour threshold is for full-time status is limited to the ACA and health insurance. Employers do not need to adjust other benefit programs that may have a different work week hour threshold in determining eligibility, such as your retirement plan. So let's talk about what a qualified plan is. Remember on the earlier slide, we mentioned that part of employer responsibility was to be in compliance with the ACA is to offer the right coverage to the right employees at the right time. The right coverage being the key phrase I'd like to address. Here's a high-level overview of a qualified plan, which is the starting point for a qualified offer. To understand the breakdown of the qualified plan, let's remember that as of January 1st, 2014, most U.S. citizens and green card holders and their dependents must be enrolled in a health plan that offers at least minimum essential coverage or pay a penalty, as you saw on the previous slide. But on the employer side, just offering minimum essential coverage is not enough for the organization to avoid coverage penalties. An employer must offer coverage that meets minimum value standards that is also affordable in order to avoid ACA penalty. The concept of what constitutes minimum value is something a good insurance broker can explain and discuss with you. We're not going to spend a lot of time on that aspect today. So let's move on to what makes an offer affordable. This is the exact wording from the final regulation issued by the IRS on February of 2014. Coverage for an employee under an eligible employer-sponsored plan is affordable if the employee's required contribution for self-only coverage does not exceed 9.5% of the taxpayer's household income for the taxable year. Well, the question is, how do I know how much household income there is for the employee? You'll note that it ties the affordability to the employee's household income for the tax year as reported on their individual tax return. Of course, they don't give us that 1040 as employers to make that determination, so we can't really use that information to determine affordability. Just to mention, the coverage affordability threshold for 2019 is now at 9.86%. It does get adjusted annually for inflationary purposes. The law has provided a means for establishing safe harbors. This allows the employer to determine what is affordable based on information that they do have, their employees' compensation. Using those safe harbors to determine affordability is critical in minimizing your penalty risk if you have lower wage workers. So you do know each of your full-time employees' compensation. Now you can choose from one of three safe harbors when applying the affordability percentage. The safe harbor establishes maximums not to exceed. Safe harbors can differ by employee type, job functionality, department, physical location, meaning you can use different safe harbors for employees in different states, as an example. Once you do establish a safe harbor for the year, you can't change it until that plan year renews. If you're unsure which affordability safe harbor you should be using, I highly recommend discussing this with your insurance broker. There are also several helpful blogs on this topic on our Integrity Data website. So let's talk about tracking employee eligibility. So as a quick recap, an employee is eligible for health coverage when they are a full-time employee as defined by the Affordable Care Act. The ACA has redefined full-time employee by abandoning the concept of a 40-hour work week to be classified as a full-time employee and reducing that threshold to 30 hours per week. By increasing the hours that need to be tracked when crediting employees' hours of service. So there are additional types of hours that will go into affecting the employee's hours of service. We've hosted a 201 webinar on guidelines for classifying an employee as a full-time and how hours of service play into that, highlighting some kind of complex situations. To view this, please check out our education site at acafluent.com to view that recording. We'll have a list of resources available at the end of the slide deck as well. The ACA does allow two methods to be used when determining how an employee is classified as full-time: the monthly method and the look-back measurement method. The look-back measurement method is generally the preferred method because it establishes a testing period where eligibility is determined not based on a single month, but on an average weekly hours over a period no less than 3 months and no more than 12 months. It allows a smoothing of the hours, which might spike 1 month to over 130, but remain well under the 130 the rest of the months, thus allowing an employer to determine the status of an employee as full-time during a future period, referred to as the stability period, based on the employee's hours of service in a prior period, generally referred to the measurement period. This method is the best measuring tool for the workforces where employees' hours vary, not dependent on a single month, but averages of service over a period of time. For the look-back measurement method is continuous. When one measurement period ends, another begins. This does get complicated, so again, we have a recorded 201 webinar that delves into this a bit more, and we will have those resources available for you at the end of the presentation. Now, what happens when a variable hour employee start date is not on the first day of the standard measurement period? Obviously, this is not unusual. In those cases, they will always work in an initial measurement period, which is tied to their employment start date. Like the criteria for standard measurement period testing, an employee must work the entire initial measurement period to be tested. Note that in initial measurement periods, the administrative period is limited. Unlike a standard measurement period that can have up to 3 months for an admin period, in an initial measurement period, the combined totals of the measurement and administrative period cannot exceed 13 months. The stability period must be the same in the standard measurement period and initial measurement period. If not, there will appear gaps in coverage as they transition from the initial measurement period to the standard measurement period. Ongoing variable hour employees, part-time employees, are tested in standard measurement periods. In order to be tested, the employee must work the entire testing period. Statistically, the longer the testing period, the more accurate the data in determining eligibility. For companies with high turnover rates, 12-month measurement periods often eliminate many employees from eligibility determination. They would be considered full-time eligible only in the corresponding stability period for that test. Continued eligibility during the next stability period would require them to pass the corresponding standard measurement period test. For variable hour employees that will continue employment, there will be a transition period where they move from an IM period, initial measurement period, to an SM period, standard measurement period. In the graph above, you'll see that there is a time at the end of the employee's IM period that the same hours will be used for both IM and the SM period testing. Even if an employee does not test eligible during their first complete SM period, if they had previously tested as eligible in their IM period, then the employer must honor the stability period associated with the IM period test. This means that companies have an added burden of managing stability periods and knowing when each employee will exhaust their eligibility. Our ACA solution has a stability period management report that will highlight employees and show when their stability period will end, whether it will be an IM stability period or an SM stability period. Check out KB article 14-044 on our website for further explanation. There are some special rules around employment status changes that must be addressed. So let's look at those. If an employee changes classification from full-time to part-time, so your reasonable expectation of whether or not that employee will work at least 30 hours per week. So if you reasonably expect them to work 30 hours per week, then you classify them as full-time for ACA purposes. Otherwise, you classify them as part-time and then you put them through those testing periods. And they must be tested as if they were a variable hour employee from the beginning, regardless of whether you classify them as full-time or part-time. So in a situation where an employee moves from full-time to part-time, they must be tested in the last testing period they would have otherwise been eligible for to determine if they would continue to be classified as eligible for coverage. And most likely they will, right? If they were a full-time employee working full-time hours, most likely they're going to be deemed eligible for what would have otherwise been their ongoing standard measurement period. If the employee didn't work enough time to be tested in any measurement period, their coverage must be extended until a testing period is met so the termination can be made. Once the move is made, the employee will be tested as any other variable hour employee, and eligibility for continued coverage will be based on those results. If you have a situation where you're able to retract coverage, that is generally considered to be a qualifying event, and COBRA, the ability to roll into COBRA coverage would apply. In a situation where an employee moves from part-time to full-time, mirrors the same rules of hiring a new employee as full-time. A company must offer health insurance no later than the first day after the employee's first full 3 months of employment in the new classification. As an example, an employee that starts on June 10th must be offered coverage no later than, must be able to enroll into coverage no later than October 1st. When we say the first day of the month following the employee's first full 3 months, which is also the criteria for a newly hired full-time employee, we are referring to the non-assessment period that is provided within the Affordable Care Act. This should not be confused with your internal waiting period policies. So your internal policy may allow for a full-time employee to enroll on the first of the month following 30 days. That doesn't preclude the fact that you do have a non-assessment period that is available to you. And the ACA gives you this non-assessment period, which you usually take when submitting your yearly reporting on who was eligible by month. And the reason for that is it does offer at least some level of protection against future penalty. The rules for when you can classify a returning or rehired employee as a new hire under the Affordable Care Act, called the break-in service rules, have been tightened. They apply to both the look-back and the monthly measurement methods. Returning employee can be classified as a new hire provided they had a break-in service for at least 13 consecutive weeks, assuming the employer is not an educational institution. Otherwise, that's 26 weeks. Otherwise, if that break-in service was less than 13 weeks, then the employee must have been previously employed for at least 4 weeks, and their absence or break-in service was greater than the previous employment period. It's called the rule of parity. The important thing to know is that determining that an employee is a new hire under these rules is at the sole discretion of the employer. You can always use the original hire date for that employee for eligibility purposes. However, you might not want to reclassify a returning employee as a rehire and keep them in the current measurement period. The theory here being that if they were absent for an extended period, they would not accumulate enough hours to be classified as full-time. There are no non-discrimination rules here. Employers do not have to adopt a universal policy that applies to all. Two employees can leave on the same date. Both can return 14 weeks later on the same date, and the employer could choose to classify one as a rehire and the other as a continuing employee with no adjustment made to their hire date. The ACA rules do not affect other areas of your benefits. It's just limited to your health benefits. The challenging part comes when you rehire employees that, if they had remained employed, would have been in a stability period. Any employee who returns to service during a stability period in which they were previously entitled to health coverage must be offered coverage that would fulfill that stability period. The good news is that the employer has until the first day of the month following the employee's first 3 full months after the return to have them signed up. So as an example, let's say an employee was in a stability period from January 1st of 16 to 12/31 of 2016, and the employee took coverage and left the company in March of 2016. That employee then returned in June of 2016. That company must offer continued coverage no later than October 1st of 2016, and the company can terminate coverage on December 31st of 2016 and wait until the initial measurement period test results if it's a variable hour employee. So let's look at the record keeping required for IRS reporting. Accurate record keeping all year long makes that yearly IRS reporting requirement much easier. So if you're keeping track throughout the year, come the end of the year, you have what you need to do what you need to do. So what is it that you need to do? Well, first, the law does require continuous accurate recording of every employee's hours of service. Every does mean exempt employees, those salary exempt employees, in addition to the non-exempt. The only exception the ACA allows for are students on a work-study program, and that's a federally allowed work-study program, not just one that you call a work-study program, and members of certain religious orders that have taken a vow of poverty. To be compliant with a requirement that no service hour be left behind, you have to find ways of recording hours that are not otherwise captured on the timekeeping system. Also, you are recording each employee's hours of service. You have 2 ways of tracking those hours in order to confirm the employees as full-time, the monthly measurement method and the look-back measurement method. Again, we have blogs on that and recorded webinars on this topic that would be good for you to look at if you have questions in this area. As we've said, monthly tracking is key to compliance. Remember that when you report to the IRS through Form 1095-C8, you are reporting on activity from the previous year. It's too late at that point to manage penalties. because penalties for non-compliant with the coverage mandate are significant and will be assessed monthly. It's best practice to monitor your payroll and benefits data monthly in order to make coverage decisions proactively. The takeaway here is that all changes in eligibility and affordability are calls to action, and that every action and data leading to the decision for it must be documented. Your monthly reports should become your system record for ACA decision making. At year end, you'll have to provide the IRS what you have or have not been offering all year with respect to health benefits. You must provide a 1095-C form to every full-time eligible employee. So if an employee was eligible any month of the year, you must provide that employee a 1095-C. And then you send copies of your 1095-C rolled up with the transmittal form 1094-C to the IRS. This is a requirement for all applicable large employers. So if you're an ALE, this applies to you, including employers choosing a pay strategy, otherwise known as they're willing to accept a penalty for not offering coverage to eligible employees. It doesn't bypass the need to complete the required reporting. And employers offering compliant coverage to all employees at no cost to any employee, even if you're offering a fully qualified plan and you're not charging the employee a dime for it, you still have to complete the required reporting. So let's translate this to some 2019 reporting dates. The Form 1095-C is due to the employee January 31st of every year. We have seen a reprieve on those dates in prior years, generally about 30 days. We don't know if we'll get one this year, but it's best to plan as though we won't, and if we get one, great. If you're filing by paper, which is allowable for employers with less than 250 forms currently, you may file that by paper. The filing date for that is February 28th. So you have to send that 1094-C along with copies of the 1095 to the IRS by February 28th. All employers may e-file those forms with the IRS, and that date is April 1st, 2020. Generally, it's the last day of March, so I'm probably going to just double check that date. So let's just summarize what we've discussed so far. So we continuously track every employee's hours of service on a month-by-month basis. We identify those newly eligible employees that are qualified as full-time from an ACA perspective. We track each employee's self-only cost of coverage, and we test to ensure that that offer of coverage meets affordability standards. On an annual basis, we determine our ALE status, provide a Form 1095-C to all ACA-defined full-time employees, and file 1094, 1095-C with the IRS. After being immersed in ACA reporting since the beginning, 2012 to be exact, and providing strong ACA reporting software and customer service around that for just as long, we began to notice that employers were just truly tired of handling ACA reporting, even if they were already using our software and support to do so. So they began to express a desire to be able to completely hand over all tracking and filing activities to us. And as much as we enjoy it, we know that staying up to date and accurate on all your ACA reporting requirements is time consuming and frankly not the job most of you signed up for. As ACA experts who have a proven track record, we're uniquely prepared to assist employers with all ACA reporting requirements. So last year we decided to introduce premium full service reporting to assist employers who truly want to get this off of their plate by completely outsourcing ACA reporting to us. This has been proven to be a successful solution both for our employers and for us. It's truly as simple as sending us your data and we take it from there. If you decide to move forward with Premium Full Service, you'll be assigned a senior account manager who will schedule a call with you to gather information to discuss his timeline for the filing year. The data requirements that were previously needed will remain the same, but with Premium Full Service, you can send us your payroll data and we'll consolidate that data into our system format, so you no longer need to worry about populating our templates. You just send that required data to us and we do the rest. So here's what we do for you as part of this service. We create the IRS forms, we generate the 1094, we'll e-file with the IRS, we'll provide secure electronic storage of your ACA information, and then assist you in resolving any errors. We can even go so far as to print and mail those forms to the employee for you. And then year-round, we'll do your variable hour tracking. A consulting will create and deliver the monthly eligibility reports and the open enrollment period reports as well. And we can provide those in PDF or Excel format. So you have an option. You can choose to subscribe to our standard service as well, which would be a subscription to our ACA software along with support from our experts. But Premium Full Service does offer some better benefits. A recap of those benefits, I think we all can agree that the most valuable benefit is getting your time back. Year-end is a busy time for most payroll and HR departments with W-2 distribution and end-of-year payroll activities. You might also be responsible for accounting year-end activities, not to mention the holidays that are going on at that point. So you can allow our team to take that burden off your plate completely. And the pricing for the full service, the Premium Full Service solution, is not that much more than your standard subscription. So just a quick look at what some of our customers have said about our team. We do like to toot our own horn a little bit. We love our customers and we like to think they love us as well. So next steps. For more information about our solution offerings, you can visit integrity-data.com/ACA. There's education available on ACA reporting, product information, video demos, customer stories, and then we've got a great blog that's got all kinds of great information. So even if you don't use us for subscription or the Premium Full Service, subscribing to our blog, keeping track of our blog is a great way to stay current on compliance-related issues, including W-4 changes. I don't know if any of us have heard about those this year, and as well, things like the 1099 NEC. So all kinds of good compliance information, including ACA compliance. We have a downloadable ebook, an infographic. We have an affordability and penalty calculator on our website, and then those blog posts that I mentioned. And you can also pick up a lot of that on our acafluent.com website. So like I said, we are going to have some time here for Q&A. I just see one question in there currently. So if you do have some questions, please put those into the question queue in the GoToWebinar control panel, typically to the right of your screen, and we'll be sure to address those. I do want to thank everybody for taking time out of their day and joining us. If you have questions on any of our solutions, feel free to reach out to sales@integrity-data.com or give us a call at the phone number on the screen. So the one question I do have in the queue at this point is, will you send out a copy of the slides and the recording? And the answer to that is yes, absolutely. Once we conclude the webinar today, we've got some administrative work to put those pieces together, but you can expect those to to come into your email in the next day or two. So we appreciate you participating today. Wanda, I'll say, why don't you just give me a call and we can talk about that. She's one of our key partners and has a customer interested in Premium Full Service. So why don't you just give me a call and we'll be happy to talk that over in detail. Any other questions, please put those into the questions queue. I'll go ahead and mention we have a great new video series going out, and I happen to have the LinkedIn page up and open. So let me just pull that over here to the screen. If you watched any of our video series last year's leading up to our big fall event at Summit, you'll remember some fun that we like to have. Well, we've got a whole new series going out. So we invite you to go out to integrity-data.com/thepayrolloffice and give you an opportunity to get a chuckle for the day. Or check us out on social media like LinkedIn, Twitter, Instagram, and Facebook. Did have another question come in. A business owner's son graduates from college and goes to work for his father at age 22. He elects to remain as a dependent on his father's insurance. How should the son be handled for ACA reporting? Should he receive a 1095-C? And that's a great question. And the answer is, as the employer of that employee, regardless of the fact that he's related, if he is eligible for insurance under ACA requirements, then he should receive a 1095-C. The part that might be a little bit confusing, self-insured employers must report those enrolled dependents in Part 3 of Form 1095-C. In that situation, the 1095-C for the business owner, assuming one is generated, would contain the coverage information for the business owner and the son. The 1095-C for the son would only populate Part 2, the offer of coverage, so maybe 1E for the offer code on line 14, and 2C enrolled into coverage, but would not include the covered individual information down below. Because that employee, that the son is covered under the father's plan, you can put him there. It would not be uncommon to put the son on both forms. The guidance in this area is a little weak still. Some people like to err on the side of caution and put it on both. As a general rule, our guidance has been to put it on the form of the for whoever's carrying the insurance. In this case, it would be the business owner. Great question. Thanks for asking. Any other questions that we might have? Please put those in. Otherwise, thank you again to everybody for participating today and joining us on the webinar. I hope you got something of value out of today's time together, and we look forward to having you join us in a future presentation. Have a great day.